Welcome to Charged Alpha. I'm Hudson and Lana is with me. Today we are breaking down CVS Health, one of the most complex and vertically integrated companies in American healthcare.
CVS is a company that has fundamentally changed what it is over the past decade. It is not just a pharmacy chain anymore. It is an integrated health services business at massive scale.
CVS was founded in 1963 in Lowell, Massachusetts as Consumer Value Stores. For decades, it operated as a regional pharmacy retailer, expanding through acquisitions into a national presence.
The transformation accelerated with the 2007 merger with Caremark, a pharmacy benefit manager, and the 2018 acquisition of Aetna for $69 billion, one of the largest healthcare deals in history.
Today, CVS operates across three businesses. Healthcare benefits, which is Aetna insurance, contributes about 40% of revenue. Pharmacy and consumer wellness contributes roughly 35%.
Health services, the Caremark pharmacy benefit management arm, accounts for about 25% of revenue. The PBM manages drug benefits for insurance plans and employers, processing billions of prescriptions annually.
The strategic logic of this integration is compelling. CVS controls the insurance policy, the drug formulary through the PBM, and the dispensing point at the pharmacy counter, a complete closed loop.
With 9,000 retail locations, CVS has an unmatched physical footprint. Minute clinics and health hub stores extend the company into primary care and chronic disease management beyond simply dispensing medication.
CEO David Joyner took over in October 2024, replacing Karen Lynch amid a restructuring period. Joyner spent his career inside the Caremark PBM business before ascending to the top role.
The restructuring has focused on rationalizing the retail pharmacy footprint, improving margins in the insurance segment, and simplifying an organizational structure that grew complex through acquisitions.
CVS has maintained its dividend through its transformation, with over 20 consecutive years of increases. The yield typically runs in the 3% range, making it attractive to income investors.
The competitive landscape is unusual. United Health Group is the closest peer as an integrated insurer and PBM operator. Walgreens competes primarily in the retail pharmacy channel.
The Aetna acquisition brought roughly 40 million insurance members into the CVS ecosystem. Cross-selling pharmacy and health services to those members is the central long-term value proposition.
CVS faces structural pressure in retail pharmacy. Drug reimbursement rates have been squeezed by PBMs, including CVS's own Caremark, creating a somewhat paradoxical internal dynamic.
The company runs at a low operating margin because insurance and pharmacy distribution are inherently thin-margin businesses. Scale and vertical integration are how CVS generates meaningful absolute earnings.
CVS is predominantly a United States company, concentrating both its risk and opportunity in the dynamics of the American healthcare system.
For investors, CVS is a value-oriented healthcare holding, enormous scale, a durable dividend, and a vertically integrated model designed to improve as each segment reinforces the others.
The core question is whether integration creates enough value to justify the complexity of assembling pharmacy, PBM, and insurance under one roof.
That's the CVS Health Company chapter. A pharmacy origin story transformed into one of the most ambitious healthcare integration experiments in the United States.
Now let's look at the latest quarter.
Into the numbers. CVS Health posted a double beat in Q1 2026. Adjusted EPS topped estimates by nearly 18%, and revenue beat by 5.7%. New CEO David Joyner's restructuring is beginning to show in the numbers. This is the inflection quarter the market has been waiting for from CVS's cost transformation, but the Aetna medical cost question isn't fully resolved. This is Charged Alpha. I'm Hudson.
And I'm Lana. CVS Health is one of the largest healthcare companies in the United States, operating three integrated segments: healthcare benefits through Aetna Health Insurance, health services through Caremark, the pharmacy benefit management business, and pharmacy and consumer wellness through more than 9,000 retail pharmacy locations and Minute clinics. CVS also acquired Oak Street Health primary care clinics in 2023. The company serves over 100 million plan members and customers. Market cap is approximately $111 billion.
CEO David Joyner took over CVS Health in late 2024, replacing Karen Lynch, who led the Aetna integration and Oak Street Health acquisition. Joyner came from a senior role within CVS's pharmacy and PBM operations and is now driving a cost reduction program targeting $2 billion in annualized savings. The restructuring includes headcount reductions, store optimization, and overhead discipline across all three segments.
Starting with CVS's financials, Q1 2026 revenue beat consensus by 5.7% year over year, driven by growth across pharmacy dispensing volume, Aetna membership, and Caremark managed prescriptions. The healthcare benefits segment, Aetna, is the most closely watched segment given the medical cost ratio challenges that weighed on the stock throughout 2024 and 2025.
Adjusted EPS beat the consensus estimate by approximately 18%, a meaningful surprise that reflects the early results of Joyner's cost reset. The EPS beat while navigating elevated medical cost ratios in Aetna demonstrates that the restructuring program has real expense discipline behind it. Analysts will be watching whether the EPS beat is sustainable as medical cost trends evolve through the second and third quarters.
The healthcare benefits segment, Aetna, is the core of the investment debate. Aetna's medical benefit ratio, which measures claims paid as a percentage of premiums collected, has been under pressure from Medicaid redetermination, ACA individual market enrollment mix shifts, and elevated utilization patterns post-pandemic. Improvement in the medical benefit ratio is the single most important driver of CVS's near-term earnings trajectory.
The health services segment, Caremark, is CVS's pharmacy benefit management business, administering drug benefits for large employers, government programs, and health plans. Caremark is the second largest PBM in the United States, competing with Express Scripts, Cigna, and Optum Rx, United Health. PBM reform legislation is an ongoing legislative risk. Proposals to regulate spread pricing and rebate structures could alter Caremark's revenue model.
The pharmacy and consumer wellness segment includes the retail pharmacies and minute clinics. Retail pharmacy profitability has been pressured by reimbursement rate declines from PBMs and insurers, generic drug competition, and declining front-end store traffic. CVS has been closing underperforming locations and shifting investment toward higher-margin clinical services at Minute Clinics and the Oak Street Health primary care platform.
CVS's balance sheet carries significant debt from the Aetna acquisition in 2018 and the Oak Street acquisition in 2023. The company has been prioritizing debt repayment over share buybacks and has maintained its dividend at a yield near 4%. Management maintained full-year guidance after the Q1 beat, suggesting the medical cost environment is showing early improvement without warranting an upward revision to the full-year outlook.
The analyst community's reaction to CVS's double beat is cautiously positive. An 18% EPS beat is material, and analysts who have modeled CVS's restructuring will be revising estimates toward the higher end of the guidance range. The hold-heavy analyst consensus reflects persistent uncertainty about Aetna's medical cost ratio trajectory. The EPS beat is encouraging, but one quarter does not confirm a sustained trend.
The constructive analyst view focuses on the vertically integrated healthcare model. CVS owns insurance, pharmacy benefit management, retail pharmacy, and primary care, a four-segment integration that theoretically allows medical costs to be managed across the full care continuum. Bulls model the Oak Street and Minute Clinic integration, creating a closed-loop health system that reduces expensive specialty and emergency care utilization.
The skeptical analyst view focuses on execution complexity. Managing four distinct businesses, each under competitive and regulatory pressure, is operationally difficult. The Aetna integration took longer than expected, the Oak Street acquisition added another integration challenge, and PBM reform risk creates a potential revenue headwind at Caremark. Bears who model each segment under independent pressure see limited near-term earnings recovery without a favorable medical cost trend shift.
Amazon Pharmacy is an emerging competitive threat that analysts track closely. Amazon's direct-to-consumer pharmacy model targets the same customers as CVS's retail locations, offering home delivery at competitive pricing. Amazon's scale in logistics and consumer trust in healthcare contexts is expanding. Bears model Amazon's pharmacy penetration, eroding retail pharmacy margins at a rate that CVS's store optimization cannot fully offset.
CVS at a low single-digit price-to-earnings multiple reflects a company trading at a distressed valuation relative to integrated health peers. United Health and Cigna trade at significantly higher multiples on their integrated model quality. Bulls who believe CVS's restructuring delivers sustainable EPS improvement see a meaningful re-rating opportunity, from distressed to peer-comparable multiples, as medical cost ratios normalize.
The bull case for CVS starts with Joiner's cost reset delivering results. $2 billion in targeted annualized savings is significant relative to CVS's earnings base, and Q1's EPS beat suggests the program is executing ahead of schedule. Bulls model restructuring savings, Aetna medical cost improvement, and Caremark volume growth, creating substantial EPS recovery over the next 2 to 3 years.
The vertically integrated model is the long-duration bull case, a health system controlling insurance, PBM, retail pharmacy, and primary care can manage medical costs more effectively than fragmented competitors. As Oak Street and Minute Clinic investments mature, the integrated model should compound, primary care reducing downstream utilization that benefits Aetna's medical cost ratio.
The 4% dividend yield provides a total return floor while restructuring plays out. CVS has maintained the dividend through earnings pressure, and free cash flow remains sufficient to sustain the payout. Income investors holding through the medical cost uncertainty collect yield while waiting for the EPS re-rating that successful restructuring would deliver.
The bear case for CVS leads with persistent Aetna medical cost ratio risk. 1/4 of EPS improvement does not establish a trend. Seasonal utilization patterns, ACA market dynamics, and Medicaid redetermination continue to create uncertainty. Bears modeling elevated medical costs persisting into the second half of 2026 see the Q1 beat as a timing benefit rather than a structural improvement.
PBM reform is the regulatory bear case. Congressional proposals to restrict spread pricing and restructure rebate flows could materially alter Caremark's revenue model. The scale of potential PBM regulation ranges from disclosure requirements to fundamental restructuring of how pharmacy benefits are administered. Bears modeling adverse legislation see Caremark's earnings contribution declining significantly.
Retail pharmacy structural decline is the third bear concern. Reimbursement compression, generic competition, and Amazon's expanding pharmacy presence create multi-year headwinds. Store closures improve remaining location profitability, but reduce the revenue base. And building clinical services at Minute Clinics takes years to generate meaningful earnings contribution.
Debt overhang constrains capital allocation flexibility. The Aetna acquisition added over $60 billion in enterprise value at a premium valuation. Carrying this debt limits buybacks and dividend growth. Bears modeling elevated interest expense alongside uncertain medical costs see limited EPS upside until the balance sheet is substantially deleveraged.
United Health Group is CVS's primary integrated healthcare peer. United Health operates Optum, combining United Healthcare Insurance with Optum Rx PBM and Optum Health clinical services. United Health's execution quality and earnings consistency command a premium multiple over CVS, making it the aspirational benchmark for what CVS's integrated model could eventually become.
Cigna is the third member of the large integrated health triad. Cigna's Evernorth segment, including Express Scripts PBM, competes directly with Caremark. Cigna's health insurance competes with Aetna in employer, individual, and government markets. Cigna's employer plan focus gives it different ACA market exposure than CVS's broader Aetna business, resulting in somewhat less medical cost pressure in recent quarters.
Walgreens is CVS's closest retail pharmacy peer. Walgreens has faced the same margin compression and has restructured its store base more aggressively. Walgreens' VillageMD primary care investment mirrors CVS's Oak Street strategy, both companies building primary care networks alongside retail pharmacy. Walgreens trades at an even more distressed valuation than CVS.
On valuation, CVS trades at the deepest discount in the integrated health peer group. United Health trades at 15+ times earnings, Cigna at 12 times. The CVS discount reflects execution uncertainty and the Aetna integration overhang. Bulls see the discount as the opportunity. Re-rating toward peer multiples on successful restructuring implies substantial upside from current levels.
CVS's options market activity heading into Q1 2026 earnings was elevated, reflecting the stock's recent volatility and uncertainty about Aetna's medical cost trajectory. Pre-earnings implied volatility was moderately elevated versus historical norms. The double beat, both EPS and revenue, resolved event risk constructively and produced a positive stock reaction, with implied volatility declining sharply post-earnings.
Post-earnings call buying emerged on the restructuring execution theme. CVS's beta of approximately 0.6 makes it a defensive stock that moves less than the broader market. But within healthcare, CVS carries idiosyncratic risk tied to the Aetna medical cost ratio that creates sector relative volatility. Options positioning in the weeks following earnings reflected cautious optimism rather than aggressive directional conviction.
Insider activity at CVS reflects CEO David Joyner's early tenure since late 2024. Joyner is building his equity position through performance compensation tied to multi-year cost reduction and earnings recovery targets. No notable open market purchases from executives were reported in the most recent 90-day window. Standard behavior for a CEO in early tenure executing a transformation program.
The combined read from options and insider data is neutral to constructive. The elevated pre-earnings implied volatility reflected genuine medical cost uncertainty that the Q1 beat partially resolved. Insider activity follows early tenure pattern scheduling without open market conviction signals. For CVS, the investment thesis turns on Aetna medical cost normalization and restructuring savings delivery. Q1 provided early positive evidence on both.
CVS delivered a double beat in Q1 2026, adjusted EPS nearly 18% above estimates, and revenue 5.7% above consensus. David Joyner's restructuring is showing early results in the cost structure.
Bottom line, the medical cost ratio is the swing factor. If Aetna's improvement is sustained, CVS is deeply mispriced at current multiples. The restructuring and integrated model are the thesis. The medical cost trend is the discount.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.